Welcome to the deep dive. We've got just a really compelling set of sources today giving you this amazing high-def picture of the Korean financial world right now.
Mm-hmm.
We're tracing the money, basically.
Okay.
But not just one path. We're looking at three totally different speeds, from these patient, super long-term infrastructure deals all the way to the, well, frankly, frantic weekly stock market action.
That's exactly right. We've kind of structured this around three different financial time horizons. You've got these multi-trillion-won projects, decades-long stuff.
Right.
Then the really immediate high-tension fight happening in the stock market as we speak. And finally, these pretty rapid strategic changes big institutions are making just to keep up.
Yeah, and our mission today is really to connect those dots. How is capital being allocated when the decisions range from, say, a 20-year contract to a 5-day bet on a stock? Okay, let's unpack this.
So to frame it up, we'll start with that ultra-stable world, long-term capital, looking at Macquarie's huge Suzhou Station deal. Then we pivot hard to the current tension, retail versus foreign investors in this market dip.
Got it.
And lastly, we look at the sort of strategic anxiety-driving change inside places like KB Asset Management. What's making them shift gears so fast?
All right, let's start with the big one, the Suzhou Station Transfer Center complex development. I mean, when we say mega deal, the total cost is pegged at, what, 2.3 trillion KRW?
Yeah, enormous. And it's not just a building. It's set to be the largest integrated complex in Seoul's southeast, which is a really critical area, over 100,000 square meters.
Wow.
It's designed as this massive connectivity hub. You've got the high-speed rail, the SRT, the new TTXA line, Subway Line 3, others, all coming together.
So a transport nexus.
Exactly. But on top of that, the plan includes a 26-story building with a department store, a hotel, offices, cultural spaces. It's basically like building a mini city.
And funding this very long-term, presumably lower-risk project.
Yeah.
It's a global player, Macquarie.
They've committed $300 billion, one through a specific fund, the KPCF5. And it's important that this isn't just like speculative foreign cash flying in.
Right.
That fund is backed by really solid domestic institutions. We're talking the Korean teacher's pension, the government employee's pension, stable long-term capital.
That structure.
Yeah.
It really tells you what they're after, doesn't it?
Absolutely. Macquarie is known globally for infrastructure. They invest where cash flow is predictable, stable. They like things like highways, terminals, utilities.
Things people have to use.
Precisely. Reliable income-generating assets, not just betting on land prices going up. They want revenue streams they can count on because the assets are essential.
Okay, but here's where it gets really interesting for me. The structure of their investment, it starts as a loan, right? So they get guaranteed interest during the construction.
Yeah, that secures their initial phase. Construction takes years, so they get fixed income. But the real payoff, the long-term prize that comes after it's built, targeted for 2029.
And that is?
They get 5 years of exclusive operating rights for the parking facility. A massive one. 15,700 pyong.
The parking lot. That's the key. Not the department store or the hotel.
The parking lot is the poor insight, yes. Think about it. Why? Because it's guaranteed revenue. It's sticky, high margin, and not really affected by economic cycles.
Okay. People need to park regardless if they're using the train, the hotel, the shops.
Exactly. It's essentially a monopoly service within that huge complex. It's essential.
So they aren't really betting on whether retail trends are good in 2030. They're locking in that steady, almost toll booth-like revenue for 5 years to guarantee their return.
That's the model. Sophisticated infrastructure investors like them aren't playing the market volatility game. They want assets shielded by long-term contracts or concessions. It lets them confidently get their investment back, plus a predictable profit over many, many years. This is the slow, patient money we're talking about today.
Okay, so if Macquarie is like the slow, steady tectonic plate movement, let's talk about the earthquakes happening on the surface. We pivot now to the KOSPI. Crazy speed there. It hit a peak right around 42.21, then boom, volatility spikes. It drops below 4,000 in just 10 trading days. And that was driven almost entirely by foreign selling.
Right. The numbers are stark. In just 1 week, foreigners net sold 7.28 trillion won worth of stock. Just dumped it.
Wow, and retail investors, the gamey, the ants.
They did what they often do. They stepped in and net bought 7.46 trillion won. They basically soaked up almost everything the foreigners sold.
Is that resilience? Or is it just massive conviction, maybe misplaced? Absorbing over 7 trillion won of institutional selling in a week is, well, it's staggering.
It's probably a bit of both. For many retail investors, it's classic buy the dip. They believe the market will bounce back or that the foreign selling is just temporary noise.
But it concentrates the risk massively, right? Especially if, as we'll get to, a lot of that buying is on borrowed money.
Exactly. That's the danger zone.
So where was the battle fiercest? Which stocks?
SK Hynix was ground zero. Foreigners dumped a massive 4.32 trillion won of Hynix alone. Retail investors bought 2.85 trillion of that, plus another 1.27 trillion won of Samsung Electronics. A real standoff over the big tech names.
But were the foreigners just selling everything? Or was there a strategy?
Oh, there was definitely a strategy. It looks like selective rotation. While they were heavily selling stocks like Hynix that had run up a lot.
Profit taking.
Right. They actually ended up being net buyers of Samsung Electronics, about 291 billion won worth. So it wasn't a panic exit across the board. It was calculated selling combined with looking for opportunities.
Okay, opportunistic buying where? What were they picking up while selling the high flyers? Stuff that got beaten down?
Precisely. Look at LG CNS. Foreigners net bought about 219 billion won worth. Why? Because the stock had just taken a sharp dive after news of a block deal involving Macquarie Asset Management, interestingly enough.
Ah, so Macquarie selling created a dip, and other foreign institutions saw a technical buying chance.
Seems like it. A clear discount opportunity. They did similar things with SK Square and other blue chips that hadn't rallied as hard before. So it's disciplined rotation. They take profits on winners and buy perceived value in laggards or recently hit names, basically letting retail investors hold the more volatile tech stocks.
Okay, that willingness of retail investors to hold the bag, as you put it, brings us right to our third threat, the risk involved. Because that conviction, that absorption of selling, it's fueled by record leverage. This concept of borrowed investment. The total credit loan balance is now, what was the number? 25.8782 trillion won.
A staggering amount. And now we're seeing the danger and consequence pop up in the data. Opposite sales. Forced liquidations.
The numbers there are worrying.
Actively alarming, I'd say. Opposite sales recently hit 21.9 billion won in a single day. That's the highest in 15 months and the first time it's gone over that 20 billion won mark this year.
Okay, let's just clarify for everyone listening. Bitsu is borrowing money from your broker to buy stocks margin debt. And opposite sales is when the stock price falls so much that the broker automatically sells your shares to get their loan back. Forced selling.
Exactly. And the ratio is key here. The ratio of those opposite sales to the total margin debt outstanding just went past 2.3%. That's a high for the year.
And 2.3%. What's considered dangerous?
Well, analysts usually start getting really twitchy when that ratio crosses 1%. They see that as a sign of excessive speculation built on shaky ground.
So we're more than double the typical warning level.
We are. And the big implication here is the risk of a cascade. You know, like dominoes. One person gets a margin call, their stock is forced sold, pushing the price down.
Triggering the next person's margin call.
Exactly. It can accelerate a market drop really quickly and hurts those highly leveraged retail investors the most.
It's a real knife edge. Because despite these record risks, record forced sales, the sources also say new trading accounts keep opening. Nearly 96 million active accounts now.
Yeah, participation is widening, but the foundation for many is getting shakier because of this leverage. It's the really explosive element in the system right now.
Okay, let's shift from the individual investor risk to the institutional side. How are the big players navigating? We're looking at KB Asset Management restructuring its ETF division. Again.
Yeah, for the second time this year. And when you see that kind of rapid back and forth, it really signals a high level of institutional anxiety in a really fast-moving market.
So what do they do this time?
They had previously merged their ETF operations and marketing into one unit. Now they're splitting them back apart. So you'll have a separate ETF operations HQ and a separate product marketing HQ.
Why? Why flip back so quickly? Didn't the integrated structure work?
Well, the results weren't there, apparently. The context is fierce competition in the ETF market. They fell behind a key competitor, Korea Investment Management, in assets under management by over 1 trillion won.
Ah, so they were losing ground in that race for the number 3 spot.
Exactly. That slowing growth seems to be the trigger. They needed to shake things up.
But undoing a restructure from just earlier in the year, doesn't that look a bit like panic? Like the first plan failed really fast.
That's certainly a risk in perception. But their official line is it's about maximizing specialization. The ETF market now is all about low fees and getting new innovative products out the door fast.
Speed to market is key.
Right. And the thinking is Maybe combining operations and marketing slowed things down. By separating them, the ops team focuses purely on running the funds well, and the marketing team focuses purely on developing new ideas and launching them quickly. They hope that clarity boosts synergy and helps them compete better. It's basically domestic institutions trying to adapt very quickly under pressure.
What a journey today. Just looking at the sheer contrast, we went from Macquarie's super patient, decade-long view,
Mm.
secured by a 5-year plan for a parking lot,
Mm.
to this intense, high-risk daily battle in the stock market between institutions and retail investors fueled by record debt. And then inside the institutions themselves, this urgent reshuffling to try and keep up. So what's the big takeaway?
I think today's sources really highlight this huge split, this bifurcation in the Korean financial world. You've got sophisticated global capital, like in the Suseo deal, doing everything possible to lock in stability and avoid risk.
Right. Guaranteed returns over decades.
But at the exact same time, you have the domestic retail sector taking on the highest levels of leverage risk we've seen in well over a year. They're positioned right on that fault line where forced selling could easily cascade if volatility keeps up.
And that really is the critical tension point for you, the listener, to watch. We've got this huge influx of retail investors, but they're carrying record debt. If foreign institutions decide to really ramp up their selling beyond just selective rotation, how does the market handle that collision between massive leverage and potentially sustained volatility? That intersection is definitely the key dynamic to keep an eye on in the coming months.